A lot of folks want to know if they should invest in PayPal stock, and did PayPal just kill the buy now, pay later platform Affirm? Is it time to buy PayPal? Well, let's talk. PayPal was a $69 stock less than 3 weeks ago. Now it's trading for $100, up 11% in after hours. What's going on? And is there any kind of risk factor going on here? And how does this affect Affirm? Well, first, some background. The company's growing at about 9 to 10% revenue. And if you take out eBay, it's actually growing at 14%. It's core business, which is great. If you annualize the last few quarters of growth, you can actually see they're growing at 16%. So they're doing really, really well coming out of 2021 and even through this crazy macro environment. In fact, they barely even talked about how bad things are in the economy in their earnings call because they're producing cash flow. In fact, $1.2 billion of free cash flow, even though they did take some losses on some investments they made. And even though they only added 6% to their user base, they ended up with 16% more transactions and total payment volume up 9%. That means existing customers are spending more money with PayPal. And this makes sense because in their earnings call, they give a really neat stat. They said the average customer has 800 transactions per year. Only 25% of those are online, and PayPal thinks that 25% will grow, and maybe more like half of our transactions will be online in the future. Now, did they kill Affirm? Well, hopefully not, but one of the big things I hated about PayPal's buy now, pay later platform in the past was they would just do what was called pay in 4, which is basically pay every 2 weeks with your first payment and then 3 times thereafter. And it's basically pay off whatever you buy within 6 weeks. I thought that was lame, and Affirm had a really good thing going for it. They would let people pay over time. That is many months. Well, guess what? Now PayPal is doing that as well. Oops, there goes the potential Affirm moat, especially since PayPal already has partnerships with over 200,000 merchants. This is a little bit of an issue given that Affirm only has partnerships with 6,000 merchants, and 90% of the people using buy now, pay later on PayPal are actually already PayPal customers. So PayPal says we already know their credit histories and their ability to repay, which gives us an advantage and lower charge-offs. Now, PayPal also says they make about 20% extra when people use buy now, pay later with them, and that's because of what they call the halo impact. Imagine they make $100 because somebody used buy now, pay later with them. Maybe they make $21 now on something else like stocks or savings or whatever. They're becoming more efficient, trying to trim headcount and make sure that they're being a better company so they have less customer service needs, and they're moving out of stocks, like really focusing employment in the stock sector because it's not too profitable right now for them, because remember, you could buy stocks with the PayPal app. But there's a big thing this company has no control over, and it's called the transaction expense. That's how much other companies are able to charge PayPal for letting PayPal users use their credit card. Now, that has become 44.7% of net revenues versus 40.5%, and it's growing. And the CFO says it's likely to get worse, which, given that they're in the payment processing business and that one thing keeps getting more and more expensive, how much leverage do they really have? Who knows? But at the moment, this company is expected to grow their earnings per share in excess of 20% for the next 3 years. The earnings per share were $2.79 last year. Now it's expected to be $4, and that's expected to grow again 20% and 20%. That's great. For a company that's selling for 25 times earnings, you're really only paying a PEG ratio of about 1.25. Not a bad way to get exposure to buy now, pay later, which is exploding. 22 million customers have used that with PayPal, and they got cash flow.